Imagine this. You've been investing for years, setting aside a portion of your income every month, keeping an eye on the market, listening to online experts. And yet your wealth grows slowly, your returns are inconsistent, and the feeling that something's not quite right never goes away. What's sabotaging your progress might not be a lack of effort. It could be the absence of something that sounds simple but changes everything: financial literacy. Without it, your investments are silently bleeding every time you make a decision in the dark. And the scariest part? This is more common than you think. In this video, you'll learn how to spot these invisible mistakes, avoid painful losses, and most importantly, build a solid strategy to protect and scale your investments using intelligence, data, and long-term vision. If you're between 30 and 45 years old, already investing or recently started, and feel like something just doesn't add up, keep watching, because what comes next could be the difference between building real wealth or becoming another statistic of people losing to inflation year after year. Most people believe investing is a skill you learn through experience, by feeling the market over time. But the truth is, many investors with years of practice still make basic mistakes that drain their results. And it's not due to laziness. The real problem is that most investors don't have even the minimum theoretical foundation. And without that, it's like trying to build a skyscraper on quicksand. Let's cut to the chase. There are 3 pillars that support every successful investor. 3 foundations that, if ignored, become ticking time bombs in your portfolio. The first is inflation. Many people only look at the raw return on an investment, but forget that money needs to maintain its purchasing power over time. For instance, if an investment yields 6% per year, but inflation is at 4%, the real gain is only 2%. And that's before considering fees or taxes. Now imagine that over 10 or 20 years. If you ignore this detail, you're not actually growing wealth. You're just keeping up with rising prices. The second pillar is risk. And again, most people get this wrong. There's systematic risk, like economic crises, and unsystematic risk, like putting everything into a single company that goes under. Without understanding the type of risk you're taking, you end up making decisions driven by fear or hype. That's where the third pillar comes in: diversification. Many believe diversification just means having a bit of everything, but that's not how it works. Real diversification is strategic. It requires understanding how assets correlate with one another. Having 5 different funds that all invest in the same companies isn't diversification. The goal is to build a portfolio that holds up under different market conditions. A good portfolio is like a well-trained team. Each asset has a specific role. This kind of construction protects your wealth during tough times and accelerates growth when the market is strong. Now that you understand the pillars, it's time to recognize the mistakes. And we're not talking about huge blunders, just small missteps, almost invisible, but capable of accumulating massive losses over time. The first mistake is overconcentration. Putting all your money into tech stocks or crypto, for example, feels exciting when the market's booming. But one sudden drop in half your portfolio can vanish. The second mistake is following trends and recommendations blindly. Every week, a new expert shows up promising insane returns on exotic assets. Many people jump in without understanding the product, the structure, the risks. It's like driving at 120 miles an hour without knowing where the brakes are. And the third and possibly most common mistake is emotional: buying high, selling low. People enter the market because everyone else is profiting, and then panic at the first sign of a downturn. This cycle of euphoria and fear destroys more wealth than any market crash. And all of it comes down to one root cause: lack of financial literacy. Investors act reactively instead of strategically. But there is a way out. And it starts with one simple step: acknowledging that financial knowledge isn't a luxury. It is a necessity. Investors act reactively instead of strategically. But there is a way out. And it starts with one simple step: acknowledging that financial knowledge isn't a luxury, it's a necessity. Investors act reactively instead of strategically. But there is a way out. And it starts with one simple step: acknowledging that financial knowledge isn't a luxury, it is a necessity. The good news is that you don't need an MBA or to become an analyst to make better decisions. Just 10 minutes a day can start to change your entire mindset. Build a learning habit, read reports, follow content from reliable sources, study the history of the assets you invest in. Use simulators to test scenarios with zero risk. Understand your real risk profile, not the one you wish you had, but the one that actually lets you sleep at night. Use spreadsheets or portfolio tracking tools to see your allocations and spot weaknesses. And most importantly, stay away from magic formulas. What truly works is understanding how the market operates, mastering the fundamentals, and applying them consistently. Think of it like this. Imagine you're planning a road trip. Would you just hop in the car without a map or an idea of where you want to go? Of course not. Yet that's exactly how many people approach investing. They open a trading account and start buying things without a clear plan. It's no wonder most of them end up lost and frustrated. So what's the solution? Simple. Start with the basics. Learn the core concepts of investing and build a solid foundation. It's like getting a map before embarking on a journey. With a map, you know where you're going, what routes to take, and how to avoid potential obstacles. Similarly, with a solid understanding of the basics of investing, you'll be able to navigate the market with confidence. You'll know which assets to buy, how much to invest, and how to manage your portfolio effectively. But here's the catch. Financial education isn't just about reading a few books or watching some YouTube videos. It's a lifelong journey. The market is constantly evolving, and so should your knowledge. That's why it's crucial to make learning a daily habit. Set aside just 10 minutes each day to study, read, or watch educational content. Over time, this small investment of time will pay off big dividends. But why is this so important? Because investing without a map is like trying to hit a target while blindfolded. You might get lucky once or twice, but eventually, you're going to run into trouble. Take, for example, the recent volatility in the cryptocurrency market. If you hadn't done your homework and understood the risks involved, you could have easily panicked and sold at the worst possible moment. Or consider the GameStop short squeeze of 2021. If you hadn't learned about short selling and the mechanics of margin trading, you could have been caught off guard and lost a significant chunk of your portfolio. The path to financial success is paved with knowledge and discipline. By understanding the basics of investing and committing to lifelong learning, you'll be able to navigate the market with confidence and resilience. So what are you waiting for? Start your journey today and secure your financial future. It's not just about avoiding mistakes, it's about maximizing opportunities. Imagine if you had invested in Apple back in 2016 when it was trading at $100 per share. Today, your investment would be worth over $500. That's a 5x return in just 7 years. Or consider investing in Amazon in 2002. If you had bought in at $5 per share, you'd be sitting on a 190x return today. These aren't just numbers, they're life-changing sums of money. Here's the secret. The best investment opportunities often go unnoticed by the masses. It's not because they're hard to find, but because most people aren't looking in the right places or don't know what they're looking for. Take the example of NFTs. When the world started embracing digital art and collectibles, savvy investors were quick to jump on the bandwagon. Today they're reaping the rewards as NFT sales continue to soar. Or consider the rise of solar energy. As more countries commit to clean energy targets and offer incentives for solar adoption, investors with foresight are positioning themselves in this lucrative market. So how can you tap into these hidden gems? It all starts with expanding your horizons. Don't limit yourself to what you already know or what's in your comfort zone. Instead, explore emerging industries, disruptive technologies, and evolving consumer trends. Stay curious, ask questions, and be open to new possibilities. Do you remember when Google was just a search engine? Or when Facebook was just a social media platform for college students? Those who saw the potential in these companies early on enjoyed extraordinary returns, and you could be next. But it takes curiosity, research, and a willingness to embrace the unknown. Wealth creation isn't a lottery. It's a skill honed through knowledge, observation, and calculated risk. Stay informed, stay open-minded, and stay ahead of the curve. Your future wealth might just be waiting around the corner. Before we wrap things up, let's address a question you might be wondering. How much money do I need to start benefiting from all this knowledge? The answer might surprise you. You don't need a fortune to reap the rewards of smart investing. In fact, you can start with as little as $100. Imagine turning $100 into $200, then $400, $1,000, and beyond. It's entirely possible with the right know-how. There are two key advantages that large investors have that you might be missing out on. First, they have access to exclusive deals. Massive funds allow them to buy huge chunks of companies at once, driving down the average cost per share. For example, when Warren Buffett bought 50 million shares of Apple, he likely negotiated a price lower than what's shown in the public records. Second, these giants benefit from economies of scale. Their sheer size lets them spread their fixed costs across millions of shares, keeping overhead low. But here's the catch. This is only true for them, not for you. You can actually buy fractional shares of stocks and ETFs. This means you can invest as much or as little as you like, all from the comfort of your phone. It's like having a personal stockbroker in your pocket, except it's free. Platforms are leveling the playing field. They're giving everyday investors like you and me the same access to the markets that the big players have always enjoyed. And here's the cherry on top. Thanks to the SEC, you can invest in the same funds as the big boys. Funds that were once off limits are now open to everyone. You can invest in the legendary Berkshire Hathaway fund alongside Warren Buffett or track the performance of the S&P 500. The playing field is changing. Knowledge is becoming the great equalizer, and it's putting the power back in your hands. You don't need millions to make millions. All you need is the know-how and a few valuable tools. See you in the next video.